So hi James, hi Andrew. Thanks for being at the Qonto studio today. So we'll switch roles for once between startup and VCs. So I'll be the interviewer and I'll ask you VCs how you can convince me to basically promote Valar in France and in Europe. As you know, it's a pretty crowded market. You're Americans investing in Europe, but you never really started a company in Europe, which seems quite interesting. So why would an entrepreneur be basically compelled to have you as investors? What is your, let's say, elevator pitch when it comes to Valar investing in European companies?
I think there's a few reasons why taking money from a US VC has some different dynamics from some of the local investors. One of the good things, there are a lot of things to criticize about Silicon Valley in the US, but I think one of the good things that has been exported, particularly from Silicon Valley, is a way of aligning the interests of the investor side and the company side so that everyone is working together towards the same goal, which is really just growing a very big and potentially important company. And so in the past, there's sort of historically been structurally some tension in that role. But I think there are just a lot of different ways of working together and looking at how you would scale a company up that US and particularly people who've spent some time in Silicon Valley bring towards the philosophy of startups. Mm-hmm. More practically, like we're willing to fly here and actually give you the money. So that's probably an important part.
I can confirm that part. So in your management team, like in your duo, how do you work and like who does what and how do you say specialize when it comes to selecting companies, investing, and then following the various investment that you have in your portfolio?
So one of the unique ways that we operate as opposed to most venture firms is we try hard actually not to break things out like that. So Drew and I take the meetings together, we source the companies together. We, as you know from your experience, we will come to Paris and meet you and the team together. We'll make the decision almost simultaneously with that as to whether it makes sense to move forward and dig deeper or just decide it's probably not for us. And so we can do that in real time and much faster than most firms. We want to avoid this thing where one of us comes over here, says, okay, this looks interesting. I need you now to fly back to New York and meet my other partners, and maybe there's a couple more people we want you to meet. There's multiple trips. We want to be able to just move really quickly. We think this is a big advantage to the entrepreneurs, that they get a very upfront, fast answer as to whether something seems like it could be a good fit for us or not. And then after we make the investment, we continue, as you know, to show up to board meetings together and not divide the companies in a way that starts to create weird political issues within our partnership. And I think that's actually becomes a big problem in a lot of other venture firms, is where the partners have allocated the portfolio amongst themselves in a way where it creates some competition for follow-on dollars in the subsequent rounds. Whereas for us, we're in the board meetings together, we're both super aligned for your success, and we're working together on that, as opposed to competitively with each other.
Mm-hmm. Well, what's your sweet spot in terms of? I mean, maybe two questions. First, in terms of focus, in terms of let's say geography focus or like industry focus. What is your focus if you have one? And then second, in terms of sweet spot, in terms of what stage are you mostly interested in, and how you basically approach the market with those criteria?
Primarily, we're a Series A firm. It's probably 70 to 80% of what we do. Mm-hmm. Occasionally, we'll lead a Series B round as well. Sometimes we'll make seed investments, but it's really mostly to get to know people. In terms of sectors, we like markets that are intuitively very large, that are highly fragmented, and where the incumbents that have most of the market share are usually these sort of 100 to 200-year-old companies that are sort of structurally find it very difficult to compete with newer entrants to the market that may have a technology or marketing advantage. And so in particular in Europe, I think the regulatory environment is superior to the US environment when it comes to starting a new insurance carrier or new banking or financial type business.
And who do you think? Who would you see as your competitors or other? Would you see other?
It's really all the other Series A firms, and there's sort of a competition in some regards for those rounds and cooperation because they will usually do some seeds and Series Bs as well.
Mm-hmm.
So, but it's the big life cycle firms you have here in Europe like Excel and Index and Ballerton and Lakestar, etc. But I think would work well with all those firms in different contexts as well.
How do you how would you calculate your an investment potential? Like when you look at a company, at a business, what are the key metrics or the key ratios or the key numbers you're looking at, or how do you, when you try to rationalize a decision, how do you?
Usually for a Series A, there's very little data to go on. We like to look a lot at what proportion of the customers of the company are coming to them through free channels, through word of mouth.
Mm-hmm.
If it's something like more than 50%, I think it suggests that there's a big need for this product in the market, and that the company has a good enough product organization that it's put something out that is really resonating with people. In particular, if this is a financial business, it's hard to get people to talk about banking or insurance or whatever with their friends. So that word of mouth number, I think, is very powerful one.
Okay. For your investments in Qonto, could you run me through the dynamics and how you saw the whole process, and maybe if it can help other European young companies to raise funds with you, Valar, or for maybe other American VCs?
So, as a first cut, because we met you before you really even had a product, which is unusual for how we do investments, but occasionally, as Drew said, we'll make investments in teams that are even pre-product or pre-revenue, where we really believe in the space or want to build a relationship with the founders, and that was the case with you guys. So, it's basically just we thought the founding team had the right chemistry together. They had the right personal backgrounds to build a very big business, having done built and sold a business before, and you were operating in a space that we think can be massive. And so that's the sort of thinnest read on which we'll make the basis of an investment. And in this case, a small seed investment is where we think the team's amazing and the space is huge. There are lots of people building businesses in spaces that are either unlikely to become, to be amenable to a multi-billion-dollar outcome. So that doesn't work in terms of our investment model. There are there's teams that aren't particularly strong that are working in spaces that could be, but we're really looking for at least those two things to come together.
Okay, great. So as I mentioned at the beginning, and as we can tell with your accent, you're Americans, you're investing in Europe. How well do you know Europe? Can you?
Are you talking about France? How well do we know France?
Yeah, we of course we don't know it as well as someone who's lived there their whole life, but we've both spent time in Europe. We have a number of companies now in London and Berlin and now Paris. We've met with companies all over the continent.
Mm-hmm.
I think that we have developed a pretty good understanding of at least the major ecosystems within Europe, the deepest tech ecosystems, London, Berlin, and Paris, and to some extent Stockholm being the major ones, as you know. And we've, over time, gravitated towards spending more time in just those major hubs as opposed to looking at the longer tail. Not because we don't think you can start a big business from these other places, people are, but we think that pretty early on in the life of a European startup, you need to have some significant locus of employees in one of these major cities that has the talent and the capital, not just for sort of the seed stage company, but to hire the 50th employee and the 100th employee and the 600th employee.
Mm-hmm.
I think you either get that in London, Berlin, and Paris, and then New York and San Francisco. And so we're really focused on those cities in terms of the teams that we're looking at, and where we're looking for companies that can grow to be multi-billion-dollar successes.
Mm-hmm.
Fundamentally, a technology business in Berlin and New York are much more similar to each other than they are different. I think there's some sort of labor law stuff that is important to understand, and there's some business cultural differences, but fundamentally startups are more similar to each other around the world than they are to other businesses in their own country. And so, I think it's not as stark a difference as you might think between doing business in New York or Paris,
Mm-hmm.
if the kinds of companies you're working with are technology companies.
And just to take that one step further, I agree with that. And a startup in New York, where we live, has more in common with a startup in London than does a startup in Silicon Valley, which is really its own, weird bubble.
They're on the moon.
Yeah, it's a totally different thing, right? In terms of the competition you have for talent, the competition you have for dollars, the proximity to sort of the big tech partnerships. So I think our base in New York gives us a good perspective on what it's like to be building a company from an urban center outside of Silicon Valley in the Western world, which is what you have here in Europe.
Yeah, I agree. Okay, thanks. Well, maybe one last question. If you were to build a company, what would it be?
There would be some kind of asset aggregation business where we just got management fees and then eventually hired some young people to take over all the work.
Yeah, it's interesting.
Like a venture capital.
Entrepreneurs forget that we are actually building a business, right? Entrepreneurs like to say, well, it's not the same. It's not the same in many respects, but we did start a startup.
We have customers, we have marketing, we have to do our own fundraising. So it's different. My entrepreneurial business was restaurants when I was younger. And in some ways, all businesses are sort of 80% the same. The 20% on the margin matters a great deal, but whether you're running a venture capital business, a new bank for SMEs, or a restaurant, you fundamentally are managing people, you're trying to acquire customers, you're trying to, sell things for more than it costs you to make them. And these types of lessons are hard won and painful to learn, but fundamentally I think management is the same regardless of what you're doing.
Thanks a lot.